Hello, this is a TradeSight special market analysis video for everyone. I wanted to talk a little bit about our Seeker tool, what it means currently on the broad market, and also a little bit about this thing you keep hearing about, the inverted yield curve, and what that typically means for the economy and the markets. I'm going to start by looking at just the daily chart of the S&P 500. And, you know, one of the things we teach people, these red numbers, those are the Seeker counts. When you get to a 13, that is what we call your exhaustion signal, which often leads to a reversal in the market. It works about 75% of the time on all time frames. We have two tools that do it slightly differently, but this is the one I like on the bigger time frames. And one of the rules of the tool that's kind of interesting is if you ever get a 13 signal that doesn't work, and then get one not too much further along on the same chart in the same direction, the second one is about 90% likely to work. So, in other words, if you get an exhaustion, it doesn't actually turn into a downward move much or at all, then you get another one, that second one usually will work. So, for example, if you look at this, this is basically the last year on the S&P, the daily chart. And you can see after we, dropped hard last December, we bounced in January and got a 13 signal in February. And even though we did kind of pause for about a month, we never really went down much at all. And I would say that that signal didn't really work. It maybe gave you a pause in the market, and that's all it really has to do. But we have certain measurements of how far it has to pull back to really be considered the successful exhaustion signal. So I would say that one didn't work. Now, here at the middle of July, we got another 13 signal, and this time, so far, it's working. We came up and hit the pink risk line, which is basically like saying once you get the signal, the risk line is the measurement of whether or not it fails, right? So if you go above that pink line, or a way to phrase it would be, if you went short on the 13 signal, your stop would be over the pink line. Never got above that. As a matter of fact, touched it exactly, and then had some down days, and we've been back and forth. Still has not completely played out. In order for this signal to work, we need to at least get down to the red line or get a new 9-bar startup phase to the downside, which we are not in the middle of at this point. So in theory, or the way this signal plays out, it's still working. It has not worked enough yet, although you could have made some good money, obviously, on the short side of the market since the signal, but it has not played out enough yet to matter. Now, why do I want to talk about this? Well, I've been showing this chart every day when I do the market previews, and every once in a while, it's important to look at things from a broader perspective. As traders, we just trade what's happening day of. I'll go long, I'll go short, I don't care. It's not our job to worry about what the market's going to do tomorrow when we're trading today, but it is useful to analyze the market and know the big picture so that if it starts to do something you're expecting, you're really on board with it, right? You're comfortable with it. And I think sometimes when we talk about the economics, it's important to understand that too, because that can also give you an idea of what you should be looking for in the market. So I'm going to pop up, what is it, this yield curve that people keep talking about, right? So here it is, and I'll slide this a bit so you can see the current. This starts back in 1982, and it reads right at the top for you, the 10-year Treasury constant maturity minus the 3-month Treasury constant maturity, right? So in other words, you would think that interest rates 10 years out are going to be better than interest rates 3 months out, right? And so if interest rates 10 years out, let's just make up numbers, are 6, and the interest rates 3 months out are 2, then the number you'd be on this scale is a 4, right? Because it's 4 points higher. So when we go below 0 on this chart, the black line, it means that the short-term 3-month is actually paying more than the 10-year, which is kind of odd, right? And what that usually means economically, and I always say, you're entitled to your own opinions. You're sort of entitled to your own interpretations of facts, but you're not entitled to your own facts. And so factually what that means has led to, consistently over and over and over again, is that within 6 to 18 months after a dip below 0 in the yield curve, we get a recession. And the recessions are marked on this chart in the shaded gray areas. So the chart starts in the middle of a recession back in 82. And you can then see in the late 80s, 1987-ish, right? 86% when we went back under zero on the yield curve, and then came the recession and the 87 crash. Okay, and then we're good all the way until 2000 plus, and then we get the inverted yield curve again, and this one was pretty quick, by the way. If you look at the one in the first one we see, we got under the zero line, but it was more like 9 months before the recession started. This one, when you get under the zero line at late in 2000, everything starts pretty quickly in 2001, and that's that crash in the market. And then the doozy, even though we didn't go as far under zero, but the doozy is the break in 2007, 2008, and then the big crash in the market and the big long recession. And we came out of it after over a year, but it still was a recession. And it still followed the yield curve. Now you can see all those. Now I'm going to slide this chart forward so you can get all the way up to today. And here's where we're at. This is the look, the current look. So when people are talking about the yield curve, that's what they're referring to, an inverted yield curve. And the reason it's concerning is because 100% of the time it leads to a recession. And of course, we all know that if we're going to get a real recession, the stock market's going to be lower. And we also know that when stock markets drop, they drop faster than they go up. It's a great opportunity for us. This is why we like this as traders, because if we're going to be ready on deck for this, right? There's some huge money-making opportunities on the short side. You'll make a lot more money on the short side of the market when it falls apart than you'll make on the long side, because it just doesn't go up as fast as it can go down. And there's definitely the setup here. Now, does it start tomorrow? Does it start in 3 months? Does it start in 5 months maybe? It's hard to say, but we're definitely flirting with the fact that it almost has to appear here now because we have the inverted yield curve. And while nothing is ever 100%, when you have something that shows that it's pretty much every time, right, you have to at least pay attention. Now let's flip back and look at the stock market. And the reason I point that out is, obviously we've got a daily chart 13 signal here, but sometimes there's bigger pictures. And one of the things I haven't shown in my previews lately is look at the weekly chart of the S&P. The weekly chart had a 13 sell signal last summer of 2018, and that led to the decline late last year, right? And now we've got another one. We've got a weekly chart 13 sell signal that is the high so far. We're nowhere near the minimum, like hitting that red line, which would be the minimum we'd see for that signal to play out. And of course, it could get worse, just like last year's got worse. Look at where the red line was. We got there and still went lower, right? And actually significantly lower. So you can go lower, but in order to justify and say that the signal worked, we have to at least get back to the red line. So that'd be 2,600 on the S&P. Okay, and that's why I keep trying to get people to focus on this. By the way, there was one back at the end of 2016, right? And that one did not work. We shook it off. And there's a lot of time before the next one. So I'm not going to say that one didn't work. So then the second one had to work 90%. But either way, both of these, that one worked last year, and this one is starting to work already on the weekly chart. Now, let me show you one other thing. Let's look at the monthly. And this is what I think should be the most concerning for everybody, because we had a 13 on the monthly that was back in 2015, actually. Remember, monthly charts, monthly candles, you only get 12 candles a year. So it takes a long time for these setups to play out, right? And there hasn't even been one going back across the 2000s until we got the one in 2015, and that one did not matter. Did not work. But we have one not too far behind, considering we didn't get one for 10 years. We've got one just 2 years later, and on this chart, that's not that many candles. So we're not quite there yet. We need one more, closing candle to get to 13. Although we're close enough that there's a lot of times we see the market just get to the 12. But at any rate, the 13 signal on the monthly, along with the possibility of a recession, the likelihood of a recession, and there may not be much for it matters what the Fed does to be able to fix it at this point, plus the weekly chart. And, there's a lot of signals out there that people should be paying attention to. And the key is, when it starts to happen, you just have to head in that direction every day, right? You don't fight the market. And we're going to make a lot of money if it starts to go that way. If it doesn't really happen, doesn't really play out, if somehow we avert and blow off signals that work 90% of the time, and the recession on the yield curve that works so far 100% of the time over the last 40 years, if somehow it doesn't happen, no problem. We'll just keep trading every day. But if you're putting down your money, do you want to go where the odds are? This is what we're watching at TradeSight every day. Thanks for listening.